It was a busy day for the U.S. stock market as we woke up to initial unemployment claims over 1 million. But as soon as we learned that news, we also learned that the FDA was going to fast track one of the testing kits from Abbott Labs, which is supposed to be much cheaper and much faster than most of the coronavirus tests that we've been used to up until this point. We also heard some news that Walmart and Microsoft are thinking of teaming up together to buy TikTok. And then we also saw some interesting movements after the Federal Reserve Chairman Jay Powell spoke from the virtual Jackson Hole meeting. It sounds like they are willing to tolerate inflation over 2%, and that had not been the case in the past. So a lot of different things going on there. We even saw the VIX up a bit here today. What it resulted in was still another all-time record high in the S&P 500, which did close up by 0.17%. NASDAQ also notched a new high on an intraday basis, but was the only of the major indices that closed a little bit lower here today. And then we did see the Russell 2000 actually give us a weekly bearish intermediate posture using that market forecast line. So we'll take a look at all of that, and then we'll get into our trade application example where I wanted to concentrate on a slightly bullish trade within the healthcare space after doing a couple of bearish trades in that sector last week. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 27th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're there, check out our description area, sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee, and we appreciate those of you that click like and retweet on these Market Outlook related posts. And then lastly, we have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in the logo in front of you. All right, let's jump into our action here today. And for those of you that are premium members following along at home, this is chart 4B, and it's an overview of the four major U.S. equity indices here in the United States. As I mentioned in the intro, S&P 500 was up 0.17% today, and you can see this nice green label lit up above the pricing action there. It says yearly high today. In fact, that's an all-time high today. The same label shows up down below with the NASDAQ composite. However, in this case, we actually closed lower by 0.34%. You can see a rare red candle on the NASDAQ composite here with today's slight pullback after hitting an all-time high earlier in the morning. Obviously, that trend is still intact. In fact, you almost had a bullish intermediate confirmation signal. That red line didn't quite cross below 20, but was kind of down in that zone near the end of the day there. In terms of some of the other action, Dow Jones had a fairly nice move today. It was the best performer of these four in front of us. It was up 0.54%. As we did see some of those banks performing well based upon that news that I mentioned before with Jay Powell. That did send interest rates higher and the U.S. dollar higher as well, and that helped support some of those banks that hopefully can make some money on net interest margin one of these days again. And last but not least, the Russell 2000 was also up today. It was up 0.28%, but the big news, as I mentioned in the intro, is that we now have a weekly bearish posture on the Russell 2000. Now, that should not come as a surprise to you. If you were listening to my presentation on Tuesday, I told you flat out that that is our expectation at this point, that the Russell 2000 would go to a weekly bearish posture. Now, remember, just because the posture is bearish does not mean you go out and take every last bit of firepower you have and do some bearish Russell 2000 trades. At this moment in time, we can see that it's still trading above a rising 30-day moving average. So despite the fact that the green line has fallen out of the upper reversal zone, we still want to respect price, and right now price has largely just drifted sideways to slightly lower, but it hasn't broken down any major support levels yet. So this is not a time when you want to be overly aggressive on that count either. Just more than anything, understand where we're at with it, and perhaps this is a moment where you start selling some covered calls or lightening up on your bullish positions that you had before, rather than getting too aggressive with outright bearish trades on the Russell 2000. Of course, that's always up to you, but just a reminder reminder that when we do see these posture changes, it doesn't necessarily have to lead to a trend change. It can exist for a very brief moment in time. All you have to do is look at something like the NASDAQ as an example. Throughout the last 3 months, you've had 4 of these little pink patches that have showed up on the chart here, and in none of those cases did price actually go below the moving average. And had you tried shorting the NASDAQ on any of those 4 instances there when you had that weekly bearish posture, you wouldn't have been very happy about it at the end of the day. You would have likely had to pull your trade off at a loss. So that's where we stand right now with the Russell 2000, still above that rising moving average, but just an indication that there's a little bit of weakness that's entered into its system compared to the 3 other charts that we have on our board right now. Let's go ahead and take a look at another chart setup. In this case, we'll go over to our 3 green arrows chart setup. And at this point, we have 3 out of these 4 charts that do have 3 green arrows setups. And the odd duck in this case is the Russell 2000. Once again, another sign that suggests that is the index that is currently our laggard in this market. So despite being up today, it is the only one with a weekly bearish posture according to the market forecast, and it's the only one without a 3 green arrows setup using the 30-day moving average, MACD histogram, and stochastics. In fact, if it closes below the moving average, it would actually have 3 red arrows. Right now, it's just kind of in limbo with 2 red arrows, 1 green arrow. The other 3 charts all are stacked for the bulls with 3 green arrows. So even the Dow Jones got into the mix here with its conversion to a 3 green arrow status just yesterday, and of course continued on here today. Now remember, the Dow Jones is not at a new high the way that the S&P 500 and the NASDAQ composite are. The Dow Jones hit its current all-time high back in, I think it was the 2nd week of February. So this 3-month chart wouldn't capture that, but we still got a little bit of work to do there, another 1,000 points or so. We got to get up above 29,000 before we can hit an all-time high on the Dow. And as I mentioned on Tuesday, very shortly, we're not going to be able to beg Apple to drag it to an all-time high quite as easily because Apple will be less influential in the Dow Jones Industrial Average after its split takes place, I believe, this upcoming weekend. So its share price will be lower and therefore less influential on the Dow. But perhaps those 3 new entrants, Salesforce.com, Amgen, and Honeywell, maybe they'll pick up the slack for Apple in that case. Whatever happens, just be aware we've got a little bit of work to do on the Dow before we hit new all-time highs there. All right, moving on now to check out our 1040 crossover method. And as we pull this up, you can see not a whole lot of change here, so we're not going to spend a lot of time on it, just simply an acknowledgement that we do have bullish postures in place on this longer strategy view. Remember, each one of these charts is 3 years in length, and we're trying to evaluate where is the 10-week moving average versus the 40-week moving average. And when the orange lines are above the blue lines, it is thought that the bulls are in control of the longer-term price action, and that is the case at this moment in time. In fact, now that we are looking at a 3-year view here rather than a 3-month view, you can see exactly where we need to go on the Dow Jones that I was mentioning just a moment ago. The high on the Dow Jones currently would be 29,568. So we do have another 1,000 points to go to the upside before we can make the claim that the Dow is setting all-time highs as well. And the Russell 2000, remember, is kind of in the same boat as the Dow. In fact, it's in a little bit of a worse boat. And the reason I say that is the Dow hit an all-time high in February of this year. The Russell 2000 did not. It got close, but it did not hit it. You can see that it hit its high way back here in August of 2018. So it's been, a couple of years at this point since we've had all-time highs on the Russell 2000. So yet one more indication that suggests the Russell 2000 has been this era's laggard compared to these other 3 indices that concentrate their efforts on the large cap area of the universe. In fact, we had a pretty good discussion about that today. Let me pop on over here to the internet real quick and show you that I taught my question and answer session class today. So think of it as kind of an ask me anything type of a class where I spend 2 hours just answering whatever questions are on our premium members' minds. So we talked about B&G Foods today, we talked about Raytheon today, we talked about Cracker Barrel today, and we talked about the cruise ship companies today, Royal Caribbean, CCL, which is Carnival, and Norwegian. But it's this question right in here that reminded me of the conversation a moment ago, which is, do we want to buy small cap companies, or do we want to buy mega cap companies, or do we want to buy kind of in between? And for every strategy, it is a little different. If you're a longer term investor, oftentimes having some heft in the security that you're purchasing is helpful in times of economic stress, whereas the smaller you are as an organization, the greater chance is that you're not going to be able to access financial resources when you need them most. But what I can say is that in this current era, and what I mean by that is in the last decade, it seems like this is a market that has preferred large cap companies, even mega cap companies, right? It's odd to say that Apple is now a $2 trillion company when it was just a couple of years ago we were trying to ponder the thought if it was possible for any company to have a $1 trillion market cap. So truly remarkable ride here. And of course, Amazon isn't all that far behind. In fact, I saw on Twitter here within the last day or so that Jeff Bezos is now worth over $200 billion, richest person ever, at least in our nominal terms. I don't know if that works from an inflation-adjusted perspective. Probably not, as there were some kings back in the old days that would be considered wealthier. But certainly amongst the giants of our modern world, there has never been somebody with a net worth of $200 billion. And Jeff Bezos is there because he built a better mousetrap. He built a website that caters to a customer, tries to get them products that they want at a price that they're appreciative of, and doing it in many cases in just a couple of days from the factory to your doorstep, or the warehouse to your doorstep. So amazing world we're living in right now, and it has kind of proven that the old thought process of the law of large numbers hasn't really worked out. There was once a philosophy that if you were a really large company, you should not expect spectacular gains after that point in time because you've kind of eaten into your total addressable market. Well, that theory has been kind of thrown out the window here in recent years with those giants like Amazon and Apple. Anyway, make sure you check out that recording if you're interested in my commentary on that. And then David taught his portfolio management class with ETFs here earlier today as well, so check out that recording. Tomorrow morning, I've got my options for long-term investors class, and then David will be teaching his technical analysis trading room. So lots of great content coming your way here at Market Scholars. Also wanted to say thank you to everybody who clicked like for me the last time I did the video. We got way up over 100. Remember the last time we got to like 101, I said, boy, we just barely scraped by. So all the rest of you that came out of the woodwork for me, I really appreciate you. 130 of you clicked like this last time around. Remember, if you want me to do the full-length kind of 30-minute version of the video, click like for me on Twitter, and as long as we're up and over 100, I'll do that. If we're below 100, then I'll just kind of stick to the abbreviated 15-minute version. And so for those of you that kind of like that shorter video, then that would give you a reason not to click like in that particular case. While we're over here as well, wanted to quickly bring up the factor selector. And in this case, I don't have a lot to share because there just wasn't a lot of change week over week. We did see one change here where quality moved into the number 2 slot, size moved into the number 3 slot. So again, a little bit of slippage there in some of those low size companies that I just got done talking about a moment ago when we were talking about the Russell 2000. And quality, oftentimes represented by a company like Microsoft. Remember, it and Johnson & Johnson are the only two AAA balance sheets companies left in the United States. So Microsoft obviously doing really well today with that big news from TikTok and Walmart. And then, of course, Apple is also known as a quality stock and has been roaring into its stock split that is just upon the horizon here. All right, let's get back on track with some chart action. And since we're talking about the factors, I did want to bring up one thing that I found kind of interesting from today, and this will be on chart 3D for those of you that are premium members that are following along at home. This has been an era that momentum has kind of taken over from a factor perspective, which is a beautiful thing for my Monday top-down trend trading class, since that is effectively what we're doing in that class. Where we've been hitting many all-time highs week after week after week here recently. A lot of those work-from-home types of stocks are in our portfolio. A lot of those video game stocks are in our portfolio. A lot of those e-commerce stocks are in our portfolio. And those are all kind of the momentum stocks of this current era that we find ourselves in right now. But today is one of those days we can't really shine the praise upon momentum. In fact, it was the only one out of these 6 factors that was actually down today. Momentum was down 0.31% today, whereas dividend yield was up 0.65, low volatility was up 0.24, quality was up 0.15%, size factor was up 0.36%, and then the value factor was up 0.62%. So it was dividend yield and value that led today, even though on the factor selector rankings from a longer look back period, they are the worst, and momentum was the worst today, even though on a longer look back period, momentum has been the best in the overall ranking. So today was one of those flip-flop days where some of those stocks that had been kind of left for dead, a lot of those bank stocks as an example, kind of came back to life here today and helped support value in the dividend yield factors. Let's go ahead and take a look at some 12 grid analysis, starting with the asset classes now, because today was a pretty big shakeup day. One thing that I should point out is that the VIX was popping today. So the VIX ended up 5% here today, but you'll notice on an intraday basis, let me right click and maximize so we can all see this a little bit easier. This is a pretty wide ranging candle that we had for the VIX today. We ended up closing and opening somewhat in the middle of that stretch, but there was a big move higher. At one point, the VIX was up well over double-digit percentages, and then kind of pulled back to end the day. Now, it was still a fairly important day. Now, remember, we don't tend to do a whole lot of technical analysis on the VIX because it's kind of its own unique beast. It doesn't really act like a normal stock would, but I will just merely point out that it did close above its 30-day moving average today, and you can also see that the green line on the market forecast went above 20 today. So a little bit of peculiar action there where we find the VIX up on a day when the stock market is up, and now the VIX actually has a bullish posture, which is usually a bad sign for the overall market because, as most of you are aware, the VIX is kind of known as the fear index. So we'll see as those two battle each other out which of those opposing thoughts is going to come out on top. But just be aware of that somewhat peculiar price action in the VIX there today. Other things to be aware of is the big story from my perspective was what was happening with interest rates. And you can see down below here in the chart in the lower right-hand corner, this is the 10-year U.S. Treasury yield. It was up a tremendous amount today. Let me right-click and maximize that as well so you can see it. Take a look at that bullish engulfing candle there on interest rates. Not only that, but we closed at the high of the session, which also broke out above a previous resistance area and really takes us all the way back to this candle right here on June 17th. So remember, much of the last 3 months, we've seen falling interest rates, falling, but there's been a change of temperature here in the last, let's call it 1 month or so. We could probably get away with making the claim now that we actually have one set of higher highs and higher lows, with this being a low, that being a higher low, with this being a high, with this being a slightly higher high. So there could be a trend change brewing here with the 10-year U.S. Treasury yield. You can see that the green line has curled back higher on the market forecast, suggesting we now have a bullish posture on this. And we also have a green moving average, meaning that price is now above a rising moving average. So, we've been kind of addressing this as I've been looking at the 12 grids in recent weeks, but I think today was a very emphatic stamp on that point that we've already been pointing out. This was a pretty aggressive candle we had today, and of course a lot of that stems from what we heard from Jay Powell saying that they're willing to tolerate inflation levels above 2, and therefore they're not going to mess with things all that much. You can see that the US dollar was up a little bit here today. That then in turn put some pressure on commodities. You'll notice that gold was down over 1% today. Oil was down nearly 1% today. Oil's chart looks a little bit stronger. It remains above that rising moving average. As I mentioned on Tuesday, the jury's still out on gold. And the longer this holds out, the less promising it looks for potential upside action. And what I mean by that is today's 1% move didn't necessarily break any major horizontal support levels or anything like that, but it did close below that moving average, which is why that moving average tip is yellow now rather than green like it was yesterday. So if this starts spending more time below the 30-day moving average, I'm going to grow a little bit more concerned that gold is going to have to give back a bit more after having such a tremendous run earlier in this year. Also keep in mind there was a big move in bonds today. That should make sense. Most of you are aware of the inverse correlation between interest rates and bond prices themselves. So when we have a huge spike up day in interest rates like we did today, we should assume that we're going to have a huge spike down day in bond prices, and that's exactly what we got. You can see the TLT chart here kind of off to the left-hand side has that dark pink background color telling us that we have a strongly bearish posture. You can also see that the candle today was so violent that we actually produced an oversold cluster signal. So there may be an opportunity for it to try to stabilize around these levels. You can see that the last time it had oversold cluster signals was back here on June 3rd and June 4th. And yes, prices did go down maybe 1 or 2 more days after that, but that was effectively when bonds started stabilizing and even putting in a pretty decent rally. That would have been a pretty juicy move right there had you bought on the oversold signal and sold on the overbought signal, right? From green dot to red dot. In other words, buy when everybody hates it, sell when everybody loves it mindset. And we're at this moment right now where we're closer to everybody hates long-term bonds right now. So that might be an opportunity for those of you comfortable with kind of reversion to the mean types of trades. You can also see we had a big down day in foreign bond market. In fact, it was a violent enough move there where you'll notice a slight change there on the moving average. The moving average now has a red tip to it, so price is now below a falling moving average. Just yesterday, the moving average was still going up, but today's move was aggressive enough where it's pulling that moving average down and also has that dark pink background telling us that we have a strongly bearish posture at this moment in time. So note again that the US dollar was up, which pressured foreign securities, including foreign bonds, but that wasn't it. It also pressured foreign stocks. Notice that EFA was down 1% today. Notice that EEM, the emerging markets, was down 0.84% today. Now those numbers aren't necessarily anything that is, jaw-dropping or anything like that. I think it's the difference from what happened in the S&P 500 that catches my eye in that situation. The S&P 500 was up to an all-time high today. Across the globe, in other countries, prices were down, and a lot of that could be attributed to the fact that the US dollar was up today. So we're going to keep our eye on this US dollar down here. Remember, it has not traded above its 30-day moving average in over 3 months. Take a look at all that price action here, and it's always below that red line. So if all of a sudden we start noticing that interest rates start going up, a lot of times the US dollar follows suit. If the US dollar starts finding its way above that downtrending moving average, it is possible we start seeing a little bit of underperformance out of the foreign financial assets out there. and that has been a really good run. As I mentioned on Tuesday, EEM is up 20% over the last 3 months, the emerging market stocks. So they've had a really good run. And right now the trend is still intact, but if that US dollar does get above that falling moving average, then all of a sudden all bets are off, and you've got to start wondering about the possibility of emerging markets starting to sell off a little bit and giving back some of that 20% gain that they've had in the last 3 months right there. So a lot of different things going on here today with that big move in interest rates and some of the reverberations after Jay Powell's speech. Let's take a look at the global markets now. And we're going to go over here to the global stocks primary 12 grid. This will be chart 5E. And as you're looking at this, it's a bit of a mixed bag. Worst chart on the board is in the lower left. That's Brazil. It's got this strongly bearish posture at this point. The other bearish postures that are weakly bearish are the United Kingdom, Italy, and Russia, although Russia and United Kingdom are still above rising moving averages at this exact moment in time. So we're kind of at a make or break moment for those areas. Italy dipped just below the moving average as of today. The stronger charts on the board I would probably identify as India and Canada. You can see that India has just been in a straight or not straight, but very consistent upward move there, almost at like a 45-degree angle. And Canada's not much further behind. They had maybe a bigger move out of the gate in June and a bigger pullback, whereas India didn't really have that. India's really been in a nice set of higher highs and higher lows. So perhaps there are opportunities there. There's a few ADRs here that do trade in the United States based upon Indian companies. I know HDB, as one example, one of the banks over there, is a tradable security in the United States. Otherwise, you could always just trade this, EPI, and it is in a very strong uptrend in this case. So that one looks really good. And Canada does as well. Those are the two that probably are competing with the United States in the upper left as far as the most consistent charts there. Germany's not bad either, and South Korea is pretty good, but I would say that nothing really compares to India right now. It's just the consistency of that move is really impressive. All right, let's get into our trade application example now. And I've already sent out the Telegram trade alert for those of you that are premium market scholars, so you already received the trade information and the fill price while the stock market was open today, as always. It's a little bit of a different trade. Let me start with the dividend stair-step chart that I use here. And the stock in question today is going to be Gilead Sciences, ticker symbol GILD. And Gilead's kind of an interesting story. They haven't really paid a dividend all that long. They paid their very first dividend back here in mid-2015. So they don't have a long, illustrious history of paying dividends the way that something like a Johnson & Johnson has done for many decades. But it is a cash cow organization. It's kind of a fascinating situation because for the last, let's call it 5 years or so, we saw pretty steady decline in prices and then more sideways action than anything else here, let's call it in the last 3 years. We actually started to see Gilead start to move up at the beginning of this year, and then all of a sudden in March, this one became kind of a superstar because it did not go down with the rest of the stock market during the coronavirus scare. And part of the reason behind that is one of the key drugs that they make, remdesivir, kind of is it's a halfway measure, helping people who do have the coronavirus feel better if they're in the hospital. It's not a cure. It's not a vaccine. It was used for, I want to say, malaria or Ebola or something like that previously, and they found that it can work reasonably well with COVID-19 as well. So all of a sudden, Gilead kind of went from being a sleepy company that was going sideways for the entire previous year to all of a sudden being kind of one of the exciting, quote-unquote coronavirus stocks. Well, I don't know if you guys have been watching it recently, but with healthcare kind of falling out of favor, as I mentioned before, we have two bearish healthcare trades in our portfolio right now. So we've already known that healthcare has kind of fallen out of favor here recently. Well, Gilead's no exception to that. They've actually come down here and are now back at the same levels they were earlier this year before the coronavirus. So it's almost as if all of that good faith that the market gave them for having that remdesivir pill and doing all that business for the coronavirus has already been given back. Now, where it's trading right now appears to be a fairly attractive place. Its dividend yield is 4.15%. It's trading at 11 times earnings. Its dividend payout ratio is only 46%. In other words, it's paying out less than half of its profits as dividends, so it certainly has the capacity to continue raising those dividends in the years to come, assuming that earnings can hold up reasonably well. And a lot of people feel that earnings are actually going to be strong because of the extra business they're getting from remdesivir. Remember, that was a drug they had already created. They didn't create it for the coronavirus. They had already created it, and now all of a sudden, out of the blue, they're getting all this extra business kind of landed on their lap. Now, they have had some negative news with some of their other drugs, and some FDA announcements have negatively affected their share price. So there is that offsetting factor. But I'm kind of fascinated with this situation where we've given back all of those prior gains and we're right back to where we were. And you'll notice that this stock has basically just traded exactly sideways for the previous year. In fact, let me go to a different chart real quick. I'm going to show you, let's just do chart 4A. I don't want a full 10 years that chart was giving me, so let me just go to 3 years. So I kind of want to show you that chunk right here. So from this dashed gray line that I'm circling up here to this dashed gray line right here. So let me kind of just zoom in from that area. So right over here is basically the start of 2019 when it was right around $68. Right here is the end of 2019 when it was around $65. That is about as flat of a year as you are ever going to find from a biotech company. You know, if I were to, get a drawing tool out, you can kind of see that from about right there, and then again, let's call it somewhere right there. Between those two blue lines is where this stock traded for 100% of 2019, and that is not a very wide range at all. So you'll notice again, when we started this year, we had that really exciting price action out of Gilead that broke us above that blue line there. So all of a sudden we were trading at levels above the entirety of 2019's range, and we stayed above there all the way up until 6 weeks ago. Here on July 20th, we started this downward move. We've now had 1, 2, 3, 4, 5, 6 straight weeks. Remember, these are not daily candles, 6 straight weeks to the downside for Gilead Sciences. And now you'll see, where are we holding up at this exact moment in time? It's almost perfectly between the blue lines on top and the bottom. In other words, we're in the middle of that prior consolidation from 2019. You'll also notice that we are very, very close to having an oversold cluster signal using the weekly candle chart. We're not quite there because we would need the green line to be in the lower reversal zone, but you can see how close we are. We're right down here at 23 right now. Remember, it would have to be below 20. The blue line and the red line are already there. So we are really close to oversold signals at this moment in time. Let me zoom out again. So I wanted to show you that the last time we had those signals would have been over here in late 2018. Remember, that was during that really terrible Christmas trading period where the market was just melting down. Well, Gilead had 2 straight oversold clusters there, about right here when it was about a $63 stock, and right here when it was about a $62 stock. And that basically called the bottom, right? It was those 2 candles that put in that low on an intraday basis of $60.32, and then it ripped higher as a reversion to the mean immediately after that, and then it went into that long sideways consolidation for the year following it. But the point is, that called the low. That was the end of that downward move. You have another green dot showing up over here that happened earlier in the year of 2018. That was May of 2018, where again you have the oversold cluster signal, and that basically called the low. You had this horrible decline in price printed that dot and immediately reverted higher. So I don't want to jump the gun. We're not there yet. It is possible that we have another week or two of bad, trading in front of us to print the oversold cluster signal. But we are now back in that range of 2019 where I think it makes some sense to start looking toward the future with a potential bullish trade. And so the trade that I did earlier today was selling a put, and I sold the October monthly contracts, and I sold the $60 strike. And we received 79 cents for that, so well over 1% return on risk for selling that particular $60 put in the month of October. Now, what that puts us on the hook for is we now are committed to buying 100 shares of stock at $60 if it does continue to fall. So I'm kind of making a bet here that the biggest chunk of this downward move is out of its system. Maybe it goes down another couple of weeks, but I think it stabilizes somewhere here in the middle of those two blue zones. And after it stabilizes, I wouldn't be surprised if it starts working its way back higher again. But if it doesn't and it continues to go down, we are on the hook for buying it at $60 if it falls through that price between now and the October expiration. Another way to think about that is, this would be the best price somebody could have achieved with Gilead Sciences in the last several years. Again, with the lowest print on this stock, $60.32, nobody in the last 3 or 4 years has bought Gilead Sciences for $60 even, yet that is what we are committing to right now. And if that doesn't happen, then that $79 that I took in for selling that premium is mine to keep. That is our trade application example here for today. To kind of offset the two bearish healthcare trades that I did last week, we're going to do a slightly bullish healthcare trade today on Gilead Sciences for those reasons I just mentioned. So with that, let's go ahead and start wrapping things up here. Thanks for checking out the video once again. If you like these longer form videos, 30 minutes plus, be sure to go click like for me over on Twitter. As long as we're up and over 100, I'll commit to doing that for you again on Tuesday. David should be back with you tomorrow, so make sure you're checking out his weekend videos, which are always outstanding. Also, I'll see many of you in my Options for Long-Term Investors class tomorrow morning. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.